Dr. Barry Burns is a businessman who has owned several small companies. His business background has taught him to focus on the bottom line, so his study of the financial markets for one purpose only, to make profits. He started his study of the markets under the direction of his father, Patrick F. Burns, who became independently wealthy through trading and had over 70 years of trading experience before passing away in 2005. Today, Barry's going to be sharing with us professional trade timing, trade timing strategies. Barry, it's all yours.
All right. Thank you, Kevin. How's my audio? Can everybody hear me fine? Do a little quick audio test here, make sure our technology is working well. I've had a technology nightmare today so far with my computer, and it was freezing up on me and causing all kinds of problems, but finally got it going. Okay, good. Everything looks great. All right, Scott, thank you. Carl, Ralph, James, Nazim, Siggy. Everybody. Okay, I'm not going to go through hundreds of names here. But anyway, fantastic, and thank you so much to the good people over at Real Traders Webinars for hosting today. What a tremendous, tremendous lineup. I've even received some emails already from people saying, wow, this has been fantastic. Thank you so much for inviting me. There's been so much great information, great speakers. So, yeah, you guys are doing a phenomenal job, and thank you for the great job that you're doing. Okay, so I'm going to hopefully do a phenomenal job as well. I'm going to do my very best. A little bit about me, beyond what Kevin said there. My dad was a trader, as he mentioned, and so that's how I got started. He started teaching me when I was 8 years old, and I'm 55 now, so that's 47 years of education, which is pretty good. And so I've seen the market go through a lot of different things, a lot of changes. And I'll tell you, that kind of experience of seeing all those changes in the market over the decades is very valuable. After my dad, I got other teachers and mentors who worked with me, and then Worldwide Traders, they brought me on to do actually a course for their members, and so I did that, and then I got sponsored to do seminars around the country, did that for a little while, got tired of the traveling, did a chat room. FuturesTalk.net hired me to come on and be the head moderator for them, doing the open and the close every day. Working with traders, I found that one of the biggest problems was the psychology of trading. So I'd already had my master's and was counseling and so forth, but I went on and got my doctorate to help people even more with the psychology of trading. I've been featured in several books. You see the titles there, and just got done writing a book for the Dummies series by Wiley and Sons, and it's called Trend Trading for Dummies, and should, hopefully, fingers crossed, should be coming out next month. And yeah, lots of other stuff. If you want to see my whole bio, go to my website, topdogtrading.com, and you can get the full bio there. But let's get on with some of the more pertinent information, the reason that you're here today. And but before I do that, actually, this is really one of the most important things you'll ever hear, and you've probably heard some of this already from some of the other speakers, but this is not just a legal disclaimer. Okay, we see these legal disclaimers all the time, but this is really where your education begins, is understanding the realities of trading. That trading is a fantastic profession. It is, it's a dream profession, really. It really is, because no one caps your income. You don't have to have a boss. You've got time freedom. You can work when you want to. You don't have to when you don't want to. So I love trading. But the truth is that most people do not make money trading. So let's just be very upfront about that. I think part of that is because a lot of people don't put in the time. As I said, it's a great profession. I'm very intentional about using that word. Trading is not a get-rich-quick, overnight money-making scheme. It is a profession. And if you treat it like any other profession that you would be studying for, then yes, then you can do very well. But treat it seriously. Don't use money you can't afford to lose. Start trading on a demo account or simulator where you're not risking any real money. Put in your time, your due diligence, get great education, such as has been presented here today, And that's the way to approach this business. So today I'm going to focus on cycles. It's about timing. And, you know, it's interesting because I don't hear a lot about this topic out there. I go on YouTube and I like to search around and see what kind of videos traders are posting on YouTube or different articles, whatever. And there's some really good stuff out there. But I don't see a lot on timing. And I studied personally under one of the greatest and most famous cycle masters of the world, and it was a wow, eye-opening experience for me. Absolutely phenomenal. And what I came to realize, though, was timing is a huge part of trading, and very little of it is addressed. If you think about it, a chart, any of us who are chart readers, such as myself, doing technical analysis, a chart has two dimensions, time and price. So, therefore, time is fully 50% of the information available on a chart. That's how important it is. It's 50% of the information we have to deal with. I get this comment from a lot of traders. They say, well, you know, I got in, I bought into the market, then the market turned around and went down, it stopped me out, but then as soon as it stopped me out, boom, it went back in the original direction of my trade. What's the problem? Timing. Timing. They had the direction right, but they had the timing wrong. I worked under a floor trader at the Chicago Mercantile Exchange. He got an apartment out in Chicago and worked with him for a while. One of the things he said to me that I'll never forget is he said, you know, Barry, retailers, and by the way, when a floor trader talks about a retailer, they're talking about someone who is being less than successful. I'm being kind. But that's, you know, that's the common parlance among those people. And so a little different than the common usage you and I like to use. But he said retailers are often right, but at the wrong time. And that's exactly what's happening there when people get in, get stopped out, and then the market goes back in their original direction. Yeah, they were right about the direction, but they got in at the wrong time. So timing is critical. If you find yourself getting stopped out too often, it's normally an issue of timing. Now, as I said, a chart has two dimensions, time and price. The famous trader W.D. Gantt said of the two, time is actually more important than price. So, oh my gosh, I mean, if you're missing out on time, if you don't have some kind of great timing strategy integrated into your methodology or some great timing tool, you're screwed, basically. You're screwed because trading is about probability scenarios. And how can you have a probability scenario that favors you if you don't even consider 50% of the information on your chart? And if W.D. Gantt is right, you're discounting the 50% that's more important than the other half. So today we're going to give an overview. I'm going to talk about various types of cycles. And there's not just one type of cycles. Usually when people think of cycles, they think of how the market moves up and down, up and down, up and down, kind of in a sine wave pattern. And that is true, and that's a very important cycle to consider. I'm not going to talk about that cycle too much today. I've got a webinar next week. I'll talk about that more on that one. But today I want to just kind of broaden your horizons and open your mind to other types of cycles that can be traded. So here's an outline of the ones we're going to cover today. Number one, seasonal or calendar cycles. All right. The next one we're going to talk about today are volatility cycles. Number three is going to be the order chaos cycle. Now, this is one I hardly ever hear anyone talk about. In fact, I think I've only ever seen or heard of one other reference to this. So this is one of my favorites, and this is one that gets a lot of people in trouble because they don't even know it exists. And wait till we get there. You're going to find out. If you're having a lot of losing trades or you wonder, how come I make money and then I give it all back? That's the reason. That's the reason, cycle type number three. So I'll explain that here in just a few minutes. Coupling and uncoupling cycles. That's a very commonly used one. And then your up-down cycles are your basic, you know, higher highs, higher lows type cycles. Okay, so let's start with seasonal or calendar cycles. These are very well known, probably most naturally occurring in the agricultural markets. In fact, this is one of the reasons that the future markets were born, is because farmers would plant their crops in the spring. They would they'd sow the crops in the spring, they'd reap them in the fall, and there was a big span of time there, of course, that was risky. The farmers were at risk when the crops could do well or the weather could be bad, pestilence, insects, locusts, whatever. Their crop may not flourish. In fact, their crop may die. When I lived in Florida, there was a big deal all the time about the orange juice industry, and that's a commodity that's commonly traded. And, if there was a freeze, then that was a disaster for Florida's economy because the orange juice industry was such a big part of it. So futures markets were born basically out of the idea of allowing farmers, in this case, to protect their positions, and they could actually sell their product before they had it in hand. And they would sell it to speculators who were willing to take on that risk, but they would take on that risk by offering what would generally be a lower price. And that would be their reward for assuming that risk. And so if everything went well, great, they made money at the end. If it didn't go well, at least the farmer had some financial protection, but they gave up some potential profits. So anyway, there's an agricultural cycle. Depends obviously whether you're in the northern hemisphere or southern hemisphere, but any type of agricultural product, which obviously we can trade, and not only that, but also stocks that are involved in the agricultural markets. You can follow them through these cycles of planting and harvesting. All right, and then there's the retail sector, very well-known one. We're going to start hearing about this real soon. Right about September is when they start talking about the retail calendar cycle, because the December time is when we have a lot of holidays for various religions as well as cultures, and that's typically when the retail sector flourishes. And some retailers, in fact, make all their money, all their profits, I should say, net profits during the retail time from September through December. And the rest of the time, they're just kind of spinning their wheels, staying in business. So a very important time. Now, again, when you start hearing about this, watch CNBC or whatever news channel you listen to, Bloomberg, whatever. You're not going to hear about this just in December. You're going to start hearing about it as people start speculating what type of expectations they think they expect to have for the retail sector. And that's where people start trading the retail season or the retail cycle. All right? So it's the old thing of, buy the rumor, sell the news. So people are always buying ahead of time on speculation. That's why we're called speculators. Travel industry, again, any type of travel stocks and so forth, there are typical seasonal or calendar cycles. Holidays, travel picks up. The summer, travel picks up, etc. You can trade these, but it's not so easy as just saying, okay, well, I'll go to, some stock or some company that is heavily involved in the agricultural market, and I'll buy it in the spring and I'll sell it in the fall. Doesn't work that way. Doesn't work that way. And again, we don't know if it'll be good news or bad news, right? Sometimes the travel season is terrible. Sometimes the retail season is terrible. Sometimes it's good. So it's not always consistent, but these are the times. In other words, it's like an alert on your screen where it says, okay, look at this now. Look at this now. And that's all these really, these calendar cycles are is, okay, this is what to pay attention to now. Now, go read the chart. You have to be able to read the chart and not just read the calendar so that you can tell whether it's a good market to trade or not. And it might be a good market to trade, but to short if things are disappointing. Okay? So this, by the way, is just one of the energies. So cycles or timing is just one thing that we use as part of a full methodology. Now, my methodology I'm not going into today. because we're focused on cycles, but I use 5 what I call energies to analyze a chart and make a trade. And one of those energies is timing. Timing. So it's just one thing to consider. All right, so here's a little example. Just thought I'd bring this one up because this is one of the most commonly known cycles, and that's they call it the Halloween indicator. And basically it's the old thing of by toward the end of October, early November, and then it may go away. You probably heard that phrase, it may go away, because historically, and it is historically true, statistically true, that over decades and decades, the market has made the vast majority of its gains, like over 90% of its gains, from the end of October to May. And then from May to November, not much at all. So what a lot of people do is they pull their money from the equity markets and they put them into some, safe, interest-bearing, maybe bonds or something like that. That's back when actually, you could actually get an interest rate on something. And they get a little interest rate during those months and they put it back into the equity markets. And that was a typical thing to do. Again, you've got to learn to read a chart because that's not always what happens. So here we're going back to October 2007. All right, so if we'll just use November because we're talking end of October, early November. So if you were to buy and then sell, well, you didn't do well that year. That year the cycle stunk. It was horrible. And then you'd go away in May. Well, going away in May worked out real good because from May to the next November, the market tanked. So staying out of the market and putting your money in some other interest-bearing account or whatever, it would have been good. Okay, then you'd come back into the market and you'd buy up and about here, and then in May you'd go away. Well, then you pretty much broke even, roughly. Did not work very well. Then you go away in May and take your money out of the market, but the problem was that time the market went up from May to November. So again, this type of cycle, this calendar cycle, it's not that it's not a good one. It is historically, statistically good, but you can't just hold to it as a religion. You have to then look at a chart, be able to read the chart and say, okay, so here's a time when I look for this. How's this going to play out this year? How's this going to look this year? Okay, so that's calendar cycles. Let's look at volatility cycles now. One of my I like all these kind of cycles, but volatility cycles are exciting. These are where you get very, very exciting trades. And I'll show you why. So I call this the XCON pattern, and that stands for expansion, contraction. And I'm talking about the range that price moves in a period of time. So the more range that a price moves in a shorter period of time, the higher volatility we have. Volatility can be directional or non-directional. Just because you have a lot of volatility does not mean that you're in a trend. And there are also very, very low volatility trends. So just because you're in a trend does not mean you have high volatility. They're two different energies. Now, here's the problem. Most people trade this backwards. So what they'll do is they'll use some sort of a scanner and they say, I want to trade stocks that are moving, or I want to trade a future market that's moving, or I want to trade currencies that are really moving right now. Whatever market it is, doesn't matter. This applies to any market. And so they do a scan based on whatever parameters they prefer to find markets that are moving, which means in a high volatility pattern. Okay, so what's the problem with that? That's a big problem, not a good idea. Because if you scan for high volatility markets to trade, what you're doing is you're often getting in right before contraction sets in. Again, if you're not aware that the cycle exists, you will fall for this every time. Many people don't understand that volatility is a cycle, high volatility, low volatility. So here's the point. By the time a scanner picks up, in other words, it has enough data that's accumulated for it to come up and mathematically say, yes, I have now confirmed that this market is high volatility because I've scanned this historical period of time, and yes, it's been in a volatility energy. Problem is, that's usually or often coming to the end of the high volatility cycle. And a lot of people don't even consider that there is a cycle. And so then what happens is you get in, you buy, you sell, whatever you do, maybe you take your options position. And in options position, with options, this is very important, by the way. You really need to be aware of this for option trading, but really for any. But for option trading, this can absolutely devastate your position. And then all of a sudden, the market volatility collapses and flattens, and it stops moving. And you don't get the range. And you're like, dang it. How come every time I get into these great markets, all of a sudden, they stop moving? And that's the kind of thing, that's the kind of verbiage that I hear from retail traders. It's like, I'm doing everything wrong. Just the time I get in, the market's been going great, and then I get in, and all of a sudden, it stops moving. So, my broker is taking the other side of my trades, or, the big guys, they're watching me, and they're taking the evil big traders. No, that's not it. They don't care about somebody's little $10, $20, $50,000 account. This is this is the nature of the market. There's a cycle. So, what do? You do the opposite. And this is what most successful trading is, doing the opposite of what most people do. So, and it stands to reason. Most people say, well, everything I do is exactly wrong. It's just amazing how wrong I am. I am so perfectly wrong in trading. It's crazy. It's miraculous how wrong I am. And that's not because, your broker is trading the other side, and they may be, but they're probably not even looking at whose account they're trading against. But it's just that you're not educated enough to know this particular thing. And that's not a bad comment. That's just like, okay, well, we all have to learn something the first time at some time. So what I like to do is I like to trade inside of contraction. So what's that mean? Well, triangles, Bollinger Band squeezes, wedges, very narrow range channels. So when I scan, I will actually scan for markets that are not moving very well, that are contracting, have low volatility. Then, again, pull up a chart, take a look at it. Got to be able to still read the chart. Just because it's in a low volatility pattern does not mean you take the trade. It's not that simple. Got to look at the chart. And then we're looking for, okay, how long has it been in a low volatility pattern? Because we want to trade when that low volatility cycle is about to end and the high volatility cycle is about to kick in. We want to get in early on that high volatility cycle, and that's exciting because then the market moves in big range, meaning we make big money in a short period of time. That's quick, fast money, and that's why these cycles are so exciting to trade. So, but you've got to be able to read the chart to help to determine, okay, are we toward the end of this cycle, and so forth. So there's more to that. Obviously, reading the chart is how you do it. Now, here is just a typical, this is what I call a meta pattern. And for day traders, this is the DAX. I like trading the DAX in Europe. But this is a typical meta pattern that you'll see most days. Not every day, but you'll see this most days. And most people know about this. The market has high volatility in the morning, lunchtime, low volatility, and then in the afternoon picks up again with high volatility. And so a lot of people will trade that. And I always watch for that. One of my trades I always watch for is if the market's been in a low volatility pattern during lunchtime, the doldrums as they call them, I will look for a breakout, an expansion pattern right after lunch. And I love that trade. Every day I look for that trade. So now the other thing though is you've got to be careful because everybody knows this pattern. Once everybody knows something, it's not going to work as nicely and neatly and textbooky as we would like. So, the people, if you're trading an exchange-centered market like the futures, when I was in Chicago, you had an advantage. You had an advantage being there. One of the advantages was you could look around and you could see who left for lunch today, who left for lunch early. Did the whales leave for lunch early? Did the big guys leave? Or are they still there? And then they might leave early, and then they may come back early. And all of a sudden the market takes off, and it's like, oh, wait a minute, lunch isn't over yet. Why is the market taking off? That's because you can't see who's there. So a little bit of advantage those guys have, although that's starting to go away. Okay, here's one of my favorite markets, or my favorite cycles to talk about, because it is so underrepresented in the trading community. This is the order chaos cycle. Okay, what's that mean? So there's two philosophies around this, two extreme philosophies, I'll say, okay? And then a lot of people in the middle, and I'm in the middle. But here's the two extreme philosophies. Number one, and you've probably heard the book Random Walk Down Wall Street, very, very famous book. And the presenters there, and by the way, they've recanted a part of what they said in that original edition, but the original proposition was that the market is a complete random walk, basically chaos, and unpredictable, that all the information that can be known about the market is known and factored into price. Therefore, there was no way to forecast or to establish an edge or any type of probability of determining what's going to happen in the future. And so basically, to be a trading is to be an idiot. Okay, I'm paraphrasing there. They never said that, but that's kind of what I pulled out of what they had to say. So then there's another extreme view. The other extreme view is that the market is perfectly orderly and predictable into the future. Now, the people who believe this are the people that you'll hear who say, oh, they usually use some kind of like either astrology or a lot of GAN stuff is used for this. Where they say they've been able to predict out into the future, way in the future, like 10 years out into the future, the exact time and price of a market. And it's all based usually on some sort of geometry. All right, so I've studied both of these obviously in depth, and when I read, the random walk stuff, I'm like, wow, that actually is kind of scary. It makes a lot of sense. Maybe I'm in the wrong profession here. How come I'm making money though? And then I read, and I actually studied under some people who believe they could predict the future of the markets way, way, way out into the future. And a lot of that made sense too. And the examples they showed made a lot of sense. And then I thought, well, these are completely contradictory positions. And yet to this day, both have followers. Both philosophies continue to stand. Neither one's been completely discredited. So how can that be? Well, the more I thought about that, then I came to realize both views stand because both do have merit. They do both have merit. But the key is this: at different times. There is a cycle. It's a cycle. Sometimes the market is very chaotic. Sometimes it is a complete random walk, and sometimes we cannot establish a probability scenario. And by the way, that's most of the time. And so there's plenty of examples for them to use. On the other hand, hey, guess what? There's people who consistently make money in the markets, consistently, over years and decades. And so, yeah, there is a way to do it, and it's because there are times when the market does behave in an orderly manner. Now, I don't particularly like the word predictable, but I prefer to, because to me that's like being able to predict 10 years in the future. I don't believe in that stuff. But what I do believe in, what I know, is you can establish a probability scenario with a viable methodology. And so I prefer to use the word probability scenario. When the market is in an orderly fashion, if you have a good trading methodology, it will put the odds on your side in those situations and at those times. The key is you got to wait for those times. You can't be trading all the time. Now, again, ignorance, and again, it's not a cut. I just mean that in the literal sense of the word ignorance, meaning not to know, which literally is the Greek etymology of the word, is just not knowing. And so people who don't know about the cycle, they fall victim of the cycle. And so they're trading all the time because they think they can trade all the time. And I get this, one of the things that a retailer will say is, gosh, the market made a big move and my trading method didn't get me in it. And that's a red sign, or that's like a red flag saying that their thinking is incorrect. Their philosophy about trading has an error that they need to correct in their thinking pattern. And that is that they think that every big move in the market is has a high probability scenario before that big move occurs. And they don't. So what? The market moved up big. Who cares? Market moves up, it moves down, it moves sideways, it does all kinds of stuff. Let it do what it wants to do. Maybe you've heard the phrase, make the market come to you, and that's what we do. What that means is you have established a high probability trading methodology, and at those times when the market does what's in your method, then you're going to make money more often than not. And so you just wait for the market to do that. The rest of the time, you don't care if the market moves up 500 points, down 600 points. You cannot grieve the loss of that opportunity because there wasn't a good opportunity. There wasn't a high probability, a high reward, low risk opportunity there. So it doesn't matter what the market did. It's going to do all kinds of crazy stuff. Make the market come to you. So this is why overtrading is the cardinal sin. Typically what overtraders are doing is they are trading during chaos cycles, which again is most of the time. Most of the time the market is just moving around randomly, and you got your retailers in there, and your retailers are throwing their little one lots in, and then they're scared, so then they pull them out right away, and they're in, they're out, they don't know what to do. And the chart looks like their mentality. The chart looks like their mentality. Very skittish, very confused, very chaotic. It's when the professionals come in with a plan, a structured, orderly plan, then guess what? The charts start to look structured and orderly. And so that's what we'll wait for. So this is the foundation of what I talked about, or just referred to as my 5 energy methodology. That's what I do. That's how I establish a probability scenario. I look for 5 uncorrelated energies to align. And those energies are, number 1, trend, which is direction. Trend by itself means nothing. Absolutely zero, zilch. Number 2, I look for momentum. That's the strength of the trend. I don't want to trade a weak trend. I want to trade a strong trend. So momentum is the strength of a move. Now, is momentum a great energy? No, it's terrible. Okay, then the third thing is cycles. That's timing. That's when do I want to enter the trade. Are cycles very accurate? Nope, they're terrible. The fourth energy is support resistance. And I like to buy off support, short off resistance, of course. Is support resistance a great trading tool? Nope, it's horrifying. And then you got your multiple time frames, your fractal energy, or your energy of scale. So I'll look at 2 time frames of the same market. And is that incredible? No, it's horrifying. It's absolutely, it will lose all the money in your account. Okay, so why do I use all 5 energies if each one of them is absolutely horrifying? And, I'm speaking in extreme terms just to get your attention here, obviously. But the point is, no one of those things will make you any money. Any one of those things will make you blow out your account. And this is why when people look at indicators and they backtest, forward test indicators, all that kind of stuff, that's freaking useless because none of those indicators do work. The key is you have to have a methodology that puts a number of things together. So when all 5 of these energies align and all 5 say buy or all 5 say sell, okay, now we got something. I don't trust any one of them by themselves at all. But the key is each one of these 5 energies are unrelated to the other 4. In other words, trend is unrelated to momentum. The market could be trending up, and momentum can actually be going south, be going down. At the time, price is going up. Why? Because they're uncorrelated energies. That's the key. 5 trend indicators would not work because that's redundant. You need 5 uncorrelated energies, and that's what makes it significant when they say buy or when they say sell. When they align, then the odds are on our side. All right, so that's how I do that. Okay, look, got a little ahead of myself there, but coupling and uncoupling cycles, a very common thing that a lot of people do, especially equity people. I trade everything, by the way, and I do that very intentionally because I like to just go wherever the opportunities are at any given moment. So I'll trade currencies, commodities, ags, metals, equities, obviously, just wherever the opportunity is, that's where I'm going to be. So what we do is we look at sectors, industries, countries, currencies, commodities, interest rates. They will couple and uncouple with the primary indexes from time to time. So we basically, follow the S&P 500 as our benchmark, which actually is a good benchmark today because the S&P 500 actually incorporates all these things as well as international markets and everything today. So just because you trade the S&P 500, don't think you're trading the U.S. market. You're not. You're trading currencies. You're trading commodities. You're trading other countries. All these things. It's so diversified. The world is such a small global place right now, and all these companies have their hands in the whole world. So it's a good benchmark to use, even better now than it used to be, in my opinion. So these cycles provide key opportunities. In other words, what we're doing is we're using the S&P 500 as our benchmark, and then we're looking for when any of these other markets start to, when they're trading with it, trading in a similar manner, or the key is to catch them uncoupling early. So the S&P is going up, and then maybe we're watching, I don't know, the Golden Dragon, China ETF, or exchange traded fund. And maybe they're trading together, and all of a sudden, boom, it uncouples. It starts going down while the S&P still goes up. Well, that, again, that's an alert. I'm going to look at that, and then I'm going to read the chart, and that provides a potential opportunity to start trading. So basically what we're doing is we're looking for the relative strength to outperform the equities. This is one way of attempting to beat the S&P 500, which is pretty much the goal that everybody has who trades or manages funds. And not many do it. Not many do it. And this is one way to attempt to do that. And then finally, there's the up-down cycles. Okay, and this is where markets just wiggle up and they wiggle down. They make higher highs, higher lows, lower highs, lower lows. Those are cycle, sine wave type moves. So on the way up, markets tend to move, make bigger price moves and spend more time in the direction of the trend. And they make smaller price moves and spend less time against the trend. Now, what we want to do then, again, I'm not going to go into this too much. Like I said, I have a webinar next week. I'll go into it in detail. But here's the key. Up-down cycles, we always use those. Always look for those. But then we combine them with volatility cycles for expansion and contraction. We also combine them with order chaos cycles. Then we also combine them with calendar cycles. So see, now we're using cycles within cycles. This becomes very, very powerful. So that's just kind of a little example here of an up-down cycle. So a cycle low, cycle high, cycle low, cycle high, and that's it. And that's my basic cycle indicator, which we modify. So next Tuesday, I will be offering a free webinar on the up-down cycles. And what I'm going to do on that webinar is, and in order to get access to that webinar, you're going to have to use the link that's going to be posted here in the room today. And then you'll get access to the free webinar. But what I'll be doing at that free webinar is not only teaching you about how to time buying lows and timing highs, I'm actually going to give everybody on that webinar for free my timing indicator. And then in the second half of the webinar, which is just going to be an hour, I'm going to teach you how to use it. So it's my gift to you. I'm not selling anything today, by the way. I have nothing to sell you today. And even on that webinar, I'm giving away my cycle indicator and a lesson on how to actually use it. And it's my timing indicator is very powerful in the sense that it will help you find the final cycle low before the market continues up, so you don't get stopped out so often. Same thing with shorting. It'll help you find the final cycle high. It avoids that problem that we were talking about before where people say, oh gosh, you know, I got in, I bought the market, it took me out, and then it went back in the original direction of my trade. This helps you avoid that. So you'll get my cycle indicator for free that day. We don't have time for it today. So the summary of my approach to high probability trading, there's more than one, but this is how I do it. I simply wait for the alignment of the 5 energies to put the odds on your side. All right, and what I'm doing is looking for a trend. By the way, when I look at a chart, I always look at it the exact same way in the same order. Everything I do is very orderly, methodical, objective, and rule-based. So every time I look at a chart, I'm never confused. I never wonder what's going on. I always know. I look at a chart, number one, look for the trend. Are we up or are we down? And I have an objective way of measuring that. Or is it sideways? If it's up, okay, maybe I'm interested in going long. That's my first decision. I'm looking to go long or short. Then number two, is it strong or weak? I don't want to trade, I don't want to buy a weak trend because it's going to fail. So energy number two, momentum. If it's a strong trend, okay, I'm still interested in trading in the direction of the trend. Then we go to the timing tool that I have, and we say, all right, now when do I want to enter this? If I want to buy the final cycle low. I don't want to buy the A point of an ABC complex retrace. That makes a lower low after I get in. Then I want to make sure there's support that I'm buying off of, so it bounces off support. And then number 5, I will not take the trade unless it's confirmed by the larger time frame. And by the way, big mistake a lot of people make. A lot of people obviously trade multiple time frames, and that's a very good thing to do. The bad thing to do is they look for trend. They look to trade in the direction of trend of the higher time frame. And I'll show you next week why that's a logical error. So the method's very robust, adaptable. I use the same 5 energy method and these cycle methodologies, whether I'm trading stocks, commodities, options, currencies, futures, and I trade all of these things. And I use it for investing, swing trading, and day trading. It's just all relative. It's very simple. I've learned over the years, you know, it's interesting, the longer I've traded, the more simple my trading has become. My trading improved. Here's another distinction between amateurs and pros. Amateurs tend to try to improve their trading by adding more stuff, adding more indicators, adding more rules, adding more, you know, whatever. I have improved my trading by taking things away, by making my trading more simple. So here is my information, and again, I'm Dr. Barry Burns with Top Dog Trading. There's my email. If you have any questions that we don't get to today, I see we got a couple minutes for questions, so I'll see if I can answer them before our time is up. But you're welcome to send me an email to ask any questions you have. I am offering today for you my free 5-day video correspondence course. You're going no charge for this at all. You get 5 days of video instructions, and so each day you'll get a new video. It'll give you about 10 minutes of instructions, and then there's a quiz at the end, an interactive quiz, and you get the answers right away. On day 4, you get one of my favorite trade setups. It's called the rubber band trade. I give you the rules, the filters, everything. And this is a good trade. Every time it sets up, I still take that trade. Okay, and then next Tuesday, my webinar. Give you my free cycle indicator and give you a lesson on how to use it. And how do you get all this stuff? Well, you got to go back to the chat box, and Kevin has posted the link. All this is only available by clicking that link, and then you'll start getting this stuff. Well, you'll probably get the first video today. I'm having trouble with my little microphone here. Okay, guys, I've got 5 minutes left. Can I take that 5 minutes to answer some questions, or do we have to move on? Oh, some people are saying they can't see the link. It's in the chat box. Let me see if I can. I can't seem to put it in the question box. Link is good. Oh, okay. Some people can see it. Ramon can see it. Yeah, it's in the chat box, at least in my GoToWebinar thing. It says chat. It's a little chat box thing. Anyway, I'll just give it to you. It's www.realtraderswebinar.com/top dog. Okay, realtraderswebinar.com/top dog. All lowercase letters TOPDOG, top dog. realtraderswebinar.com, top dog. Okay, you got it. All right, it's working. All right, cool. Okay, well, I don't have much time here, but I'll see if I can answer a question or two. Okay. Yes, Neil asked about, does it work on Thinkorswim? Absolutely, absolutely. Yeah, my methodology works on any charting platform because I don't use any proprietary indicators. The charting or the cycle indicator I'm going to give you, basically what I'm doing is I'm just taking a very common indicator that's already on your charts. And yes, it's on Thinkorswim, it's on NinjaTrader, it's on TradeStation, it's on OmniTrader, it's on Metastock, it's on MT4. It's on every charting platform I've ever seen. So it's a very, 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 very common one. But then we make changes to it. Okay, we got to make changes to it. So, and then I'm going to show you the changes we make. And then there's certain patterns we trade on it. See, just like praise bars can have patterns like head and shoulders, double tops, wedges, triangles, and candlestick, different type of candlestick patterns. Indicators have patterns too. And I'm going to show you the pattern. There's a particular pattern that we trade. Actually, there's 6 of them on the cycle indicator. So, but yeah, Thinkorswim, you're totally, any charting platform is fine. Okay. Da, da, da. All right, so, oh, my time is up. I've got like 2 minutes. So, yeah, I literally do have 2 minutes. Okay, so I'm going to stop there and turn it back to the guys at Real Traders to close things out and say whatever they need to say. I want to thank you all for being here today and spending your time with me. I've enjoyed it, and I hope to be working with you real soon. And I just love trading. Love, 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 love trading. So never be shy about contacting me or asking me any questions. You're never bothering me. Favorite part of my day is at the end of the day when I sit down in front of my computer and I download my emails and I answer traders' questions. So I love it. Okay, everybody, thank you very much. And again, thanks to the good people at Real Traders Webinar. Wow, you guys always put on amazing, amazing events, and this one's been no exception.